His expertise span advisory and consulting for multinational and local corporates on cross-border transaction, as well as training assignments for banks, corporate and industries bodies like Federation of Indian Export Organizations, ICAI, etc. Mr. Daya is also the author of Basics of Trade and Indian Perspective, a book which continued to serve as a valuable resource for professionals in the field. On behalf of SIRC of ICAI, sir, I thank you for accepting our invite today. As a token of our appreciation, I would like to invite CAT Suguma sir to present the mementos to Mr. Abin Daya sir. Thank you, sir. So we look forward to have a productive and inspiring session today with Abin Daya sir. Sir, I'd like to take the session with you, sir. Thank you.
Good afternoon, sir. So first of all, thank you for taking time out from your busy schedule. I know it's a working day, but still, thank you for having taken time out from your schedule and being here. It's definitely a great privilege to be here addressing professional from ICAI, SIRC on this topic. So typically when I get requests for these kind of sessions as a resource person, the request is usually like, can you take a half-day session on FEMA? Can you take a full-day session on FEMA, etc. So FEMA being such a vast area, it's quite difficult to figure out, what I should say, what I should talk about, what I should not talk about. And again, the expertise levels of the participants, that's quite varied. So again, there's a confusion. I think, Sridhar sir, you also would be quite aware of this. It's a fine balancing act, not to make it too complex and not to make it, too basic. So that's quite difficult. But so it was quite refreshing that when the request came this time, it was specifically for a deep dive session. So, there was no question about the expertise levels of participants, know the basics of ODI. Again, very specifically overseas direct investments. So that is basically what was wanted to cover. So since we are doing a deep dive session, the premise is that all of us are aware about the basics of overseas investments. So we will not go into the basics right now. Again, we will be restricting our discussion specifically to overseas direct investments, ODI. So we will not talk about OPI, we will not talk about ESOPs, sweat equity, etc., which are primarily done under overseas portfolio investments. So today we will be talking about investment by Indian investors into unlisted entities outside India and into 10% or more of the paid up equity capital of listed entities outside India, and again, debt, guarantees, etc., etc. So that's basically what we are going to talk about. Now, a few days back, we were discussing, I was discussing with another company secretary, and they told me, sir, Companies Act is so very structured. You have the act, you have then the rule. So section, look at the section, the subsection, look at the rule, the sub-rule, you get everything. ஆனால் உங்கள் ஃபெமாவில் வந்து ரூல் இருக்கா ரெகுலேஷன் இருக்கா எது இருக்குது எது இல்லை, that itself is quite difficult to understand. So where to look for a rule, where to look for a regulation, what exactly to refer, that itself is quite challenging. Now if you look at overseas direct investments itself, prior to August 2022 there was no rule. It was only regulation. It was Regulation 120, which actually superseded Regulation FEMA 19 of 2000, which was superseded by FEMA 120 in May 2004. So that is where the overseas investment regulation started from. So there was overseas investment regulations were basically FEMA 120, and all the other notifications which came in, they were under FEMA 120. And 2022, suddenly FEMA overseas investment rules got notified, And then we have the overseas investments regulations, FEMA 400, and you have APDAR Circular 12 of 22nd August 2022, which is again the overseas investment directions. So now, as auditors, obviously there is a requirement that you need to be aware about overseas investment regulations or whatever are the guidelines pertaining to overseas investments, because ultimately when we sign off on the Form FC Section E, the net worth certificate, there are some declarations, there are some validations that we are doing, right? I mean, there are no non-compliances. Again, at the end of every year, the certificate that is attached to the APR, that also gets signed off by the statutory auditor. So, I mean, when we sign off saying that there are no non-compliances, all compliances have been met, we also need to be aware what exactly are we certifying. So it's quite critical, as particularly from an auditor's perspective, to understand what are these compliances. Now we have 4 case studies today. I hope, have you received, I mean those who have registered, have you received a case study over email? You have received? Okay. So there are 4 case studies. It would have been good if you could have also had physical copies of the case studies. So is it possible to arrange for the physical copies of the case studies for the participants? Can we take a print? No problem. I mean, we have about half an hour because we are doing the preliminary before we start off on the case studies. So it would be good if we can have physical copies of the case studies also. So there are 4 case studies that we will be discussing today. So these case studies, these are real life cases, real life issues which we have come across or which we have handled or are handling. I think if you can get Xerox of that, that will be good. About 10-15 copies if we can take Xerox, that will be good. So basically, these are cases or these are issues which we have handled. Yeah. No problem. So these are issues or these are cases, real life cases which we have handled or are currently in the process of handling. But before we get into that, so it is not a theoretical discussion today. So, but before we get into that, there are certain concepts, there are certain terms that I wanted to present in front of you because these need to be understood a little better. So some of these concepts need to be understood a little better. So before we start off on the case studies, we will discuss regarding this. So we are discussing only investment in unlisted equity, unlisted debt, non-fund based obligations, and listed equity more than 10%. So not covering ESOPs. Basic understanding of overseas investments, covers investments by resident individuals as well as Indian entities. So these are the applicable regulations currently. Overseas investment rules of 2022, overseas investment regulations, overseas investment directions. So, I mean, fortunately or unfortunately, we still don't have an FAQ. Otherwise, we would have added that also to the list. Now, one of the critical terms that was introduced by OI rules is the concept of control. Before, and in the earlier version of FEMA 120, there was no concept of control. Okay, this started getting talked about, or this was introduced in the OI rules. So what exactly is control? Control is defined as the right to appoint majority of directors, right to control management or policy decisions, 10% or more voting rights. So this is basically what control is defined as. Now from a practical perspective, what exactly does it mean? So because at the end of the day, when you fill up the form FC, you need to declare that I have control. The investor has to declare that I have control or I do not have control. What is the difference in these two and how do banks look at it? So as an auditor, when you are signing off on the form or signing off on the Form FC, what exactly do you look for? If the investor holds more than 51% stake, then so there is, it's quite clear. The Indian investor has got control in the foreign entity. If the Indian investor holds less than 10% stake, then it is assumed that he does not have control. The Indian investor does not have control at all. So that ambiguity is between 10% and 51%. What exactly, if it is more than 10% and less than 51%. So basically, it says, since the definition says 10% or more voting rights, ADs assume that the Indian investor has control. So when you file Form APR, and if the investor holds more than 10%, and if you say you do not have control, then the AD might ask for additional documents, right? So this is basically, so if it is between 10% and 51%, the control has to be established by way of other documentation such as subscription agreement, shareholder agreement, voting agreements, etc., etc. Now, practically, what is the impact of having or not having control? So there are two types of investors that we have, right? Indian entities are there, resident individuals are there. Two types of investors. There are three parts which are impacted by with or without control. There is the type of financial commitment that can be done by the Indian investor, then APR, how the APR can be prepared, and incorporation of a step down subsidiary. So these are the three parameters. If you look at an Indian entity, it doesn't matter whether the investor has got control or no control, he can infuse equity without any problem. The question of control comes when the Indian entity wants to provide a loan to the foreign entity. Here, the Indian entity can provide a loan only to foreign entity where he exercises control. So control is an essential part of being able to provide loan to the foreign entity. If the Indian entity does not have control in the foreign entity, he cannot give loan, he cannot give guarantees. So this is basically So this is basically the issue. If control is not there, then the Indian entity cannot give a loan. Secondly, APR. While filing APR, if the Indian entity has control, says that I have control in the foreign entity, then mandatorily the APR has to be prepared on the basis of audited financials of the foreign entity. So a lot of times we hear clients saying that, sir, but audit is not mandatory in the host country. Doesn't matter. Mandatory does not mean prohibited. Mandatory does not mean prohibited. If you get it audited, nobody is going to question you. Just because it says that it is not mandatory, if you get it audited, nobody is going to question you. So, audit is mandatory to prepare APR if the Indian investor holds control in the foreign entity. Otherwise, for APR to be prepared on the basis of unaudited financials, it has to be where the Indian entity does not have control in the foreign entity. Third, step down subsidiary, not a problem at all. Irrespective of whether you have control or not, the foreign entity can have step down subsidiaries under it, and under the current regulations, these step down subsidiaries can also be in India. Earlier, SDS coming into India was not possible. Under OI rules, this is permitted. Now coming to resident individual being the investor. Type of financial commitment, irrespective of whether he has control or no control, Indian resident individual investing in the foreign entity cannot give loan to the foreign entity. His investment can only be by way of equity. No loan can be provided by a resident individual who invests in a foreign entity. Again, APR, same audited financials if he has control, unaudited financials if it is without control. Also, Step down subsidiary doesn't matter whether he has control or no control. If he has control, see, permitted in India or abroad, that is different. I mean, he does not have control in the foreign entity, that is, but if he has control in a foreign entity, that foreign entity cannot create step down subsidiaries under it, irrespective of whether it is in India or outside India. Investment has to be necessarily in an operating entity only. So this is the impact of investment with control or without control from a practical perspective. So when you are signing off, these are the things that we need to educate our investors, saying that, sir, are you sure that you want control in the foreign entity? If you want control, these are the kind of things that you can do, these are the things that you cannot do. So this is something which has to be explained to them. Next one is investment limit. Investment limit remains the same as earlier, 400% of net worth for Indian entity, $250,000 for per financial year for resident individuals. That is okay. Now, what do we mean by investment limit? What do we mean by aggregate financial commitment? Aggregate financial commitment should not be more than 400% of the net worth. Net worth of the Indian entity is calculated in INR. So, which means that for comparison, if you have to compare, your aggregate financial commitment also has to be calculated in INR. So, how do you arrive at INR, the INR value? So, overall financial commitment is your cumulative INR value of equity invested, loan given, any guarantees provided, bank guarantee, corporate guarantee, any mortgage given, done, any pledge of shares done, personal guarantees issued by promoters of the Indian entity. That is also part of aggregate of the financial. So if there are, let's say for example, if there are 3 promoters and all three of them have given personal guarantee favoring a foreign lender, then the aggregate of all these 3 personal guarantees has to be taken. So all this added up is basically your overall financial commitment. Now how do you arrive at the INR value? You can do it in 2 ways. One is that you add up, so this is an example, okay. Let's say as on 30th of April 2025, in foreign currency terms, the total financial commitment is 28.8 million. Okay. One thing that you can do is that what is the USD INR rate of 30th of April 2025 and multiply it with the 28.8 million. So if it is USD INR is 85.60 multiplied with these two, you will get 246.53 crores. This is what you will get, right? The alternate way of doing it is that you take the INR value of each transaction. You take the INR value of each transaction as on the date of the transaction. Add up the INR value. If you add up the INR value, you will get it to 226.15 crores. Okay, these are the 2 ways in which you can look at it. Now, in most cases, you will not have a problem in the sense that you can do either of these things. You won't have a problem. But there might be certain cases where the investor is already at the edge of that 400% net worth. So in this case, let's say for example, net worth as on 31/3/2024, if it is 60.65 crores, this is about 406% somewhere odd, and this is about 389% somewhere odd. If you take it in this manner, then you can do the transaction. If you take it in that manner, you can't do the transaction. So which one is correct? Which one is correct? If you look at the Form FC, the footnote to Form FC Section E, the net worth certificate that we are signing off, statutory auditors are signing off, the footnote, it says that foreign currency rate has to be taken either the rate as on the date of issuance of the certificate or the date of the transaction, whichever is earlier. So actually, this is the correct way to take it. Calculating the INR value of each transaction, adding it up, this is actually the correct way to take it. But the problem is that our clients don't maintain a record like this, right? Our clients don't maintain something like this. So if We have to do it, then we have to sit and prepare. If we have 10 clients, we have to prepare, sit and maintain records like this for each of our clients, which is quite cumbersome. And again, a lot of times what happens is at this exchange rate, ideally, what should be the exchange rate? This exchange rate should be the rate that is taken from the debit advice that the client gets from the bank. When the outward remittance is being done, he gets a debit advice from the bank saying that this is the INR value that we have debited from your account. So that exchange rate is the one that they should be taking. And a lot of times the debit, particularly if the transactions are quite old, he won't have the debit advices, right? And he wouldn't have maintained something like this also. Now, in that case, what you can do is that you can take the RBI reference rate. There is an RBI reference rate archive where you can go and get the reference rates for 4 currencies, USD, Euro, GBP and Yen. You can get the reference rates of 4 currencies. You can take those reference rates and you can utilize it for calculating the INR value of each transaction. So, this is also possible. But to make it simple, if it doesn't impact the 400% net worth, I mean, if it is not at the border, you can utilize, for simplicity's sake, you can utilize that method also. It is not wrong. It very well works, right? Again, see here the other thing is that you can ask the client to provide you with this data. Again, the problem is that if the client is giving you this data and you are signing off, there is also the added responsibility on you to check whether these rates are correct or not. Without validating these, you can't simply sign it off, right? So my suggestion is that if the transaction value is not breaching that 400% net worth, then you can very well use that for the purposes of simplicity. Yes, sir. Yes. No, sir. So this is different. So this is not the individual, the promoter investing in his personal name. This is not the investor investing in his personal name. This is, I am the promoter of XYZ Private Limited. XYZ Private Limited has done investment outside India in a foreign entity. That foreign entity is borrowing from a bank outside India. Let's say, for example, Bank of Baroda, Oman, they are borrowing from BOB. I am giving a personal guarantee in my capacity as the promoter to Bank of Baroda, Oman. This is basically what it is. So this is not covered under LRS. No. The value of all this should not cross 400%. The value of this should not cross 400%. So basically, let's say that, okay, let's say this guarantee, let's say is personal guarantee. Okay, personal guarantee by a promoter, by let's say, correct. Sir, okay, let's look at it this way. Tomorrow, if this guarantee is invoked and if the promoter has to pay this money, how will the Indian company treat this money being sent out by the promoter? This would come either as a loan advanced by the promoter to the company, or it would be an equity investment by the promoter into the company, right? Because it is. What is the proximity between promoter giving guarantee to somebody? Sir, for what purpose? The objective of the guarantee. What is the objective of the guarantee? The objective of the guarantee is for a subsidiary of the Indian company in which he is a shareholder to avail loan. For this, let's say for example, let's forget about the foreign entity. Let's talk about an Indian company. I am the shareholder, I am a promoter of XYZ Private Limited. XYZ Private Limited is availing a loan from ICICI Bank Limited. For that, ICICI Bank has asked a personal guarantee from me to the extent of the value of the loan, which is let's say 10 crores. the company is not, the company is unable to repay. The bank comes after me under the personal guarantee. I am forced to pay 10 crores. How does this 10 crores?
So it will be treated as loan for the company from the guarantee.
Correct, exactly. Exactly. It is,
That's where I
huh,
the same thing happens in case of foreign entity.
huh,
And the Indian promoter was given the guarantee
hmm,
as compensation to foreign bank or whatever.
right?
Then it becomes a loan by the promoter to the
No, it is the
foreign entity.
no, Indian promoter cannot give a loan to the foreign entity, right? So it goes as it has to go to as a loan to the parent in India. The parent in India, because ultimately it is the parent in India who has to support the foreign entity.
Considering the accounting principle, I am not sure how it will be accounted in the books of the Indian company as a loan from promoter to the
Contract. There's a specific contract.
Hmm.
It is invoked and the Indian promoter has to pay the money to the foreign.
There is any counter guarantee. Company gives, Indian entity gives guarantee to the foreign entity.
Okay.
And director gives a counter guarantee to Indian company.
Okay.
Okay, we can.
No, this is how under FEMA, this is how it has to be. Yeah. So basically,
From the accounting perspective.
understood.
Because such cases,
Huh.
you should have a tripartite agreement where the ultimate beneficiary is the Oman Bank,
Huh.
the Indian investor company in India,
Hmm.
and the guarantor.
Right.
These three people should have a offline or something on a tripartite agreement by which when the guarantee is invoked,
Hmm.
that means the loan from the guarantor,
The remittance by the
the guarantee amount will be treated as an investment
in the books of the Indian company. Hmm.
It will be either as a loan or equity, and this is because ultimately it is the obligation of the Indian entity which has.
Absolutely, it is the correct. It is the obligation of the Indian entity which is supported by a guarantee by the promoter of the Indian company. So basically, I mean, the treatment as far as FEMA is concerned is that it is being given on behalf of the Indian entity which is the investor in the foreign company. This is an additional provision which is given to support, and therefore it has to be covered under the 400% net worth applicable for the Indian entity. So, here quite interestingly, when we are talking about this, I have to also tell you there is also a provision where a group company can give guarantee, a corporate guarantee to a bank. So, say for example, XYZ Private Limited is the Indian entity whose subsidiary XYZ PTE Limited in Singapore is availing the loan, right? Now, XYZ Private Limited has got a group company called ABC Private Limited here in India. Now, ABC Private Limited is giving a corporate guarantee on behalf of XYZ PTE Limited for getting the loan, right? Now, here the investor is XYZ Private Limited in India. Guarantor is ABC Private Limited in India. Here, the guarantee amount would be calculated against 400% net worth of ABC Private Limited, not XYZ Private Limited. So that difference is correct. Giving the guarantee. So this is basically how the treatment is taken. Yes, sir.
For the financial commitment, the non-fund is 50% is only considered.
50%. Performance guarantee is 50%, financial guarantee is 100%. That still remains. 50% for performance guarantees, 100% for financial guarantees. That still remains. Okay. So net worth, basically the calculation as provided under Companies Act, how net worth is to be calculated. Now, a lot of times what happens is that clients come and say that, sir, please advise me whether I should invest as a resident individual or as a company from my company. What is the difference? So, when you look at investment by resident individuals and by Indian entities, there are some key differences. The first and foremost is pertaining to the investment limit. Indian entity can invest up to 4 times of its net worth. Resident individuals can invest up to $250,000 per financial year. March 31 தேதி அன்னைக்கு you can send $250,000. April 1 தேதி அன்னைக்கு again you can send $250,000. So that is, so it is per individual per financial year. So that is the first one. Second thing is that, second thing is resident individuals can give or do financial commitment only as equity. You cannot give loan. If it has to be given as a loan, then it has to be given through the entity. So yesterday I got a call from another client where two resident individuals have incorporated a company in Denmark. They have another private limited company here. That private limited company is not a shareholder in the Denmark entity. They wanted I told them, sir, you cannot, individuals cannot give loan. So can I give loan from my Indian company? I said, you can give loan from the Indian company, provided the Indian company is a shareholder in the foreign entity. So that Indian entity has to first make equity investment into the Denmark company and then subsequently they can give a loan. So that is basically how it is.
Sorry to interrupt.
Yeah.
If the Indian company has to make an investment, it has necessarily make investment of more than 10%.
Yes,
Control,
absolutely.
and then make
Then give a loan. It has to make an investment of more than 10%, acquire control, and then it has to, then only it will be qualified as a lender in the foreign entity. Right. And thirdly, the resident individual can only invest in an operating entity, which means that now operating entities can also have step down subsidiaries under it, but FEMA does not believe that. FEMA says that if you are an operating entity, it has to be a standalone operating entity. You cannot have subsidiaries under it. So resident individuals can only invest in foreign entities where there are no step down subsidiaries either in India or outside India. And this is true where the resident individual holds 10% or more. Basically that, because that will be qualified as having control in the foreign entity. If a foreign entity in which a resident individual has invested incorporates a step down subsidiary, then the individual has to exit that investment. He has to sell and he has to come out. Right? Whereas Indian entities can, the foreign entity incorporated by Indian entities can incorporate step down subsidiaries outside India or within India up to 2 levels. So that is now permitted from 2022 onwards. This is again something which you certify when you certify the APR. All receivables have been received within the stipulated time. What receivables are we talking about? First and foremost, we are not talking about export receivables. Why? Because export receivables, adukku oru thani oru track vera irukku. 9 months, from the date of export, money has to be realized and repatriated to the country. That is a separate thing that is going on. So we are talking about any other receivable other than that.
But the form does not say. The form says
Receivables. The understand.
Because one is a current account, other is a capital.
Illa sir, illa. It's a current account and capital account. Here, if you see the regulation is that receivables should be realized and repatriated within 90 days from the date it is due. Now, if you start including export receivables also in that, then your 9 months does not hold good anymore. So, which is why you're right, that interpretation is there that this does not cover export receivables. Here, when we talk about receivables, this is about your interest on loans, any dividend that is due from the foreign entity, any other management fee or any other service charges, etc., etc. These are all the receivables.
Charges, you mean this management charges?
Correct, management, royalty.
Example.
Sir, Indian entity.
Royalty has nothing to do with investment.
No, it is not just investment. Any receivables. Huh.
Your consensus on the fact that only from the point of view of investment, whatever due is to be collected.
Correct. Huh.
So while saying so, what do you mean by royalty?
Any service charges.
Approximate to investment.
No, it is not. See, royalty could also be relevant to the investment agreement. the permission to use their technology outside, the permission to use their brand name outside. Say for example, Reliance, right? Reliance is a name that is known worldwide. If Reliance incorporates a foreign entity and it permits the use of the brand name Reliance in exchange for a royalty, right? So that is basically what we are talking about over here. Any management fee. The parent entity is devoting the time of its management personnel for assisting in the affairs of the foreign entity, right? In those kind of cases, that management fee has to be realized. So that becomes part of your receivable. So anything related to your coming out of your investment and your investment agreements with the foreign party. That is basically what we are talking about over here. It has to be realized and repatriated. Now, this is where a lot of gaps also happen, because if you look at the old loan agreements, particularly if the loans have been given long back, a lot of loan agreements don't have a interest payment schedule, principal repayment. Principal repayment on the date it is due from 90 days. Yes. So, a lot of those old loan agreements, they do not have.
I say is anything that is covered with the financial commitment. Fine. Guarantee commission.
Correct.
Or if it's a loan, it's an interest.
Correct.
Investment is a share.
Yes. Dividend.
Whatever.
Correct.
I start a company, then after 2-3 years, I enter into an agreement for using my name. I'm not able to see any proximity between these.
Sir, the law again says any receivable. It does not say, again, when we look at it from that perspective, it does not say only the ones which pertain to your investment or the money having gone out. It talks about, or your financial, it does not segregate that it is financial commitment. Why we are excluding export of goods and services, why we are excluding that? Because there is a separate timeline that is prescribed for realization and repatriation of those monies.
Any royalty is also a current account transaction. We have the time of 180 days to collect. The moment you raise an invoice, or as per the agreement, it is due on that day.
Due.
Collect within 180 days.
No. Any due, your royalty is again a service charge. From the date of your invoice, if you have raised an invoice, there would be a due date on that invoice. From the due date, 90 days, within 90 days.
No. See, just like any other royalty also comes in the current account.
Correct.
You have 180 days or whatever the time separately there. Again, if you are restricting to 90
Sir, export of goods and services, any service that is exported, any goods that are exported, the timeline is 270 days. Yeah, 270 days from the date of export, right? Now, royalty, whether it is a service export, there is no service being rendered over there. It is an invoice that is generated for a particular.
For service, there is no necessity something to be rendered. Even use of others' asset is also a service. In my view, royalty is only a service.
Okay, sir, I think.
You are using my asset. You are paying royalty. I think that is also considered service.
Okay, so yes, sir.
No, see, the question is when you raise an invoice,
Huh.
it is 90 days.
Huh.
But in many cases, where you have an agreement, they say every quarter, at the end of every quarter,
Yeah.
within 1 month of the course of the quarter, royalty is payable. In such cases, you don't raise an invoice, money comes in automatically.
Money comes in automatically.
When you raise an invoice, there is 90 days clicks in.
Sir, where there is an agreement, it is subject to that agreement. You have a due date on the basis of that agreement. So, what the law says is that 90 days from when it is due, whether that due date is calculated on the basis of an invoice or on the basis of an underlying agreement, from that date. Okay. Now, these ODI FDI structures where an Indian entity has invested outside India and that foreign entity is investing back into the country, these were prohibited prior to 2022, August 2022. But under the current rules from 2022 onwards, this has been permitted up to 2 levels from the foreign entity. So, which means that first level step down subsidiary, second level step down subsidiary is permitted, not beyond that. So, if you look at a structure, Indian entity invests in a foreign entity incorporates a step down subsidiary. So, this is the first level step down subsidiary. This first level step down subsidiary can incorporate a second level step down subsidiary in India. Okay, so, this is permitted. Again, it can incorporate another second level step down subsidiary outside India, right. Now, this second level step down subsidiary cannot incorporate a third level step down subsidiary. Similarly, this second level step down subsidiary also cannot incorporate here in India, this also cannot incorporate a third level step down subsidiary. It can also be that here outside India, third level step down subsidiary is subject to the common regulations in the host country, etc., etc. But I think that would be breach of company law provisions, right. If you put a third level step down subsidiary, while FEMA doesn't take that into consideration, but under Companies Act provisions, you might have challenges in doing that. I think there was a news item quite recently where RBI has come out and said that we will not permit any further, if there are non-compliances, you will not be permitted to do any further transactions, etc., etc. So, RBI is simply reiterating what is already there in the regulations. Regulation 12 says that if there are delays, reporting delays which have not been regularized, you will not be permitted to do any further transactions in that particular foreign entity. That is basically what RBI, that's what the regulation says. So, RBI is simply reiterating that. Why are they reiterating it? Because, see, as per the provisions of the regulation, RBI has given a time period of 3 years from the date of notification of the regulation for any non-compliances, reporting delays to be regularized by way of payment of LSF. Beyond that, it will have to be taken up for compounding, right. So, which is why RBI is now reiterating this, so that we are already in May 2025. So, Form FC, when we sign off on section E of Form FC, statutory auditors, we are signing off this. We have verified the records and we certify that no delay in reporting is pending for regularization as required under Regulation 12 of Foreign Exchange Management OA Regulations 2022. This is what statutory auditors are certifying. What does Regulation 12 say? Regulation 12 says that a person resident in India who has made a financial commitment in a foreign entity shall not make any further financial commitment, whether fund based, non-fund based, directly or indirectly, till any delay in reporting is regularized. This is what Regulation 12 says. So, what are these delays? What are these reporting delays that need to be regularized? To understand that, we need to first understand what are the due dates. What are the due dates? Incorporation of a foreign entity. There is a change in this treatment of incorporation of a foreign entity between FEMA 120 and OI rules. There is we have that being talked about in one of the cases that we have. Incorporation of a foreign entity, date of incorporation as per the MOA or certificate of incorporation. This is now being taken as the date of financial commitment. Equity infused, date of outward remittance, or loan being given, date of outward remittance. That is the due date of reporting. Guarantee, issuance date of the bank guarantee or SBLC. Corporate guarantee, date of corporate guarantee. So, if you are signing off the corporate guarantee today, if you are issuing the corporate guarantee today, you cannot go and submit the document to the bank today and expect it to be reported today. Because bank will need its own time. They will need 3-4 days for vetting of the documents and then doing the reporting. So ideally, when the client is giving a corporate guarantee to a foreign party on behalf of the foreign entity, the guarantee document along with Form FC should be provided to the bank prior to the CG being issued, being signed off. Go ahead has to be obtained from the bank saying that we have taken this on record, now you may issue the corporate guarantee. So when we sign off the Form FC, we have to provide initially when we give, we have to give an indicative date on which the corporate guarantee is issued. And once the go ahead comes from the bank, and when the guarantee is issued, we have to go and go back to the bank and we have to intimate them that, sir, we have issued the guarantee. Restructuring of financials of a foreign entity, 30 days from the date of restructuring. Disinvestment, 30 days from the date of inward remittance. Sometimes entire investment gets written off. There is no inward remittance. So 30 days from the date of disinvestment. Setting up of a step down subsidiary, again there is a change in the treatment. Earlier, under FEMA 120, setting up step down subsidiary, change in shareholding pattern, any post investment changes in the shareholding pattern of the foreign entity, the due date for reporting was 30 days from the date of such change. If the foreign entity is setting up a step down subsidiary, 30 days from the date of incorporation of the SDS, or change in shareholding pattern, new joint venture partner gets joined, it used to be 30 days from the date of such entry of the JV partner. Now that requirement has been taken out. So what FEMA now says is that reporting requirement is you need to include those details in the APR for that particular year. So your due date is 31st of December of that particular year when you have to file the APR. That is your due date right now. There is no separate reporting required. Submission of share certificate 6 months from the date of the outward remittance, the equity remittance. So these are the due dates. Correct.
Inward, that is then inward, 60 days you have to.
Correct.
But outward, they are only saying certificates to be.
Yes, certificate. So basically, no, they are not talking about allotment. You can do the allotment on 179th day and submit the share certificate on 180th day, still complying with the, Now regulation 11, we talked about regulation 12, right? Regulation 11 says how delays have to be regularized, the timeline for regularization, delay in reporting. Split up into two, transactions which have happened prior to 22nd of August 2022 and transactions which have happened after 22nd of August 2022. So, after 22nd 2022, straightforward, up to 3 years LSF, beyond 3 years compounding. So, this is aligned with our FDI requirement now. FDI also same thing, up to 3 years delay LSF, beyond 3 years compounding. Right. So, that is the same thing which is being followed here also. Now, transactions prior to 22nd August 2022. Okay. Here, what the regulation says is that up to 3 years from the date of this notification, all those transactions can be regularized by way of payment of LSF. So, even a transaction which was done in 2010, reporting delay happened, can be regularized by way of payment of LSF till 22nd August 2025. Beyond that, it has to be compounded. Now, the problem is that a lot of us believe that if a transaction was, done, due date, it did not get reported on the due date, but it has got reported subsequently and it has got captured in the project profile, everything is now done, or APR, due date, beyond the due date it was submitted, but it has been now recorded in the project profile, then it means it is done. It is not. Getting it captured in the project profile alone is not sufficient for regularization, because regularization has to be done by way of payment of late submission fee. Let's say a transaction which was done on 1st of January 2020. The reporting happened, the financial commitment done on 1st of January 2020. Reporting happened on 15th of January 2020. 15 days late. It has been captured in the project profile. Even before the new rules came in, reporting had got completed, right? But even for that transaction, LSF has to be calculated, LSF has to be paid. Only then that transaction will be considered as regularized. Corporate guarantee issued on 1st of April 2021, reported on 30th of June 2021. April, May, June, 3 months delay. It has to be regularized by way of payment of LSF. LSF has to be paid. That is when it will be considered as regularized. So simply getting that reporting, that entry included in project profile is not regularization. Regularization is payment of LSF. Only then it will be considered as regularized. And if it is not done by 22nd August 2025, future transactions will not be permitted. So, when we sign off on the form FC section E, there is one part which says that part which I showed you, which says that all delays have been regularized. We have to ensure that before we sign off, we have to ensure that it is regularized. That is something which has to be taken care. Right. So, yes, sir. So we have to follow up with the bank. No. So from the AD side, if it has been uploaded in the portal, it will appear in the project profile with a remark saying that submitted to RBI. So there is submitted to RBI. There is a status called submitted to RBI. There is another status called approved. Once it is ratified by RBI, the status will change to approved. If it is showing as submitted to RBI, then for the moment you can rest assured that it has been given in the in the project profile. In the project profile under the APR column, right? If the bank has uploaded that data into the RBI system, it is known as the OID system, Overseas Investment Division system, right? Into the OID system, if the bank has uploaded the data, then it will reflect in the APR part of your project profile saying submitted to RBI. RBI then ratifies it. So when RBI ratifies it, the status will change from submitted to RBI to approved. So at least it should appear as submitted to RBI. So please check if that is appearing. In the project profile you can check. In the project profile you can check whether it is appearing and if it is showing as submitted to RBI. Yes, sir. Yes, sir. Correct. It was not permitted.
So this is specifically there was concern on round tripping because of which it was not.
Correct.
So by this now it's officially round tripping is permitted.
Sir, see, what do we mean by round tripping? What do we mean by, round tripping is you send the money out, again bring the money, again the same amount of money comes back in, etc., etc. Again, I wouldn't say that officially round tripping is permitted. Basically you have to basically justify the business rationale for having an entity incorporated here in India, right? So sometimes what happens is that clients want to set up holding entities outside India, investment holding entities outside India, and those holding entities then will have step down subsidiaries across different countries. And as part of that, they will also have one step down subsidiary here in India as well. So these kind of structures are now permitted. The Indian entity. Not individual. I am talking about Indian entity. Indian entity, not individuals. Individuals cannot. Individuals cannot.
What is the reason for the change of mind? Prior to 2022, they did not permit. What reason they did not permit it? What has changed after 2022?
Sir, I think it's so I see one is that there were a lot of genuine transactions which were actually happening. there was business rationale for some of these structures which were there. Again, what RBI is also doing is that RBI is depending more on the authorized dealers to ensure that these transactions are not fuzzy transactions and these are being done for a genuine business rationale, with a genuine business rationale, and not just for the purpose of round tripping, as you mentioned. So that check RBI now expects the authorized dealers to do. So if you have sent $100 outside to your foreign entity outside, and the foreign entity is again send that same $100 back into India, that is definitely round tripping. So then what is the rationale? What was the why couldn't you hold an entity here in India? So obviously, if there is a structure like that, the foreign entity will incorporate a subsidiary here in India, right? But when this gets reported as in your APR, the next question that will come from RBI is that, obviously, is that what is the rationale? What was the purpose? Or the AD, what was the purpose? Why wasn't it possible for the Indian entity to incorporate a subsidiary directly here in India? What was the objective of a middle layer outside India? What is the rationale? So please provide your rational explanation for this. Otherwise, RBI can always, and in those cases where there is a doubt regarding round tripping, RBI can always, regulator can always come back and say that I'm sorry, we are not willing to permit this. You will have to unwind. Even now. Sir,
that is one-to-one correlation should not be there.
Correct. Sir, I mean,
Again, I am distinguishing with the individuals.
Individuals
Who have clearly prohibiting round tripping.
Absolutely. Individuals, you have clearly said that. Forget about.
How they can.
No. See, particularly with respect to capital account transactions, anything that is allowed is always under review. Anything that is allowed is always under review. It can be reviewed at any point of time and questions can be asked. Why? What is the rationale? For any capital account transaction, it's not just about overseas investments, even for FDI. You can very well have questions asked saying that what is the rationale? You please explain to me. No, it is, sir, that's what. So if we are able to provide a valid justification, if you are able to provide a valid rationale saying that, yeah, this is basically what was needed this is what we plan to do, this is our future project, this is our future projections. If you are able to convince a genuine business case, then obviously it will be permitted, sir. It is not that, if I ask you a question, you will not be permitted. It's not that way. It is our responsibility to provide that response back to the regulator and explain why something is done the way it is done, and of course it can be taken up. That's how it is. Okay, now coming to the questions. Now, the first question or the first case that I have presented in front of you, it's quite an interesting one. So, a gentleman, an individual, he incorporated a subsidiary outside India in 2019, and what he did was that in 2019, he made a current account transaction. He remitted money, 1,695 Canadian dollars. He remitted out from Canara Bank, where he had a savings account. So, for that, he received an invoice from the foreign consultant. So, this was sent out as consultancy charges to the foreign consultant for incorporating the foreign subsidiary. Now, what happened was that when the foreign entity got incorporated, they considered this 1,695 as a payable reimbursement that was payable to the Indian shareholder, individual, and what they also did was that out of 1,695, the share capital, authorized capital of the foreign entity was $10. They capitalized $10 and they allotted shares to the gentleman over here. So, no outward remittance was done from India. So, since no outward remittance was done from India, UIN was not generated, and since UIN was not generated, APR could not be filed. So, till 2021-22, it kept on going like that. with no compliances being done. Then he also exited his banking relationship with Canara Bank and he went to ICICI Bank. So we started discussions with ICICI Bank on how to regularize this. So a couple of things. One is that if you look at the contraventions that have happened in this, what kind of contraventions are there? So first, investment by way of capitalization of receivables is not permitted for a resident individual. Okay, so this is something which is there in FEMA. Why do we say that? So regulation 11 of FEMA 120. So since this is under FEMA 120 because this happened in 2019, right? So this is under FEMA 120. So under FEMA 120, if you look at regulation 11 of FEMA 120, it talks about capital investment by way of capitalization. It says Indian entities can invest by capitalizing receivables due from the foreign entity. It does not permit resident individuals. It says Indian entities, right? So resident individuals are not permitted to invest in foreign entities by way of capitalization, right? So regulation 5.1, why do we say that it is a contravention of regulation 5.1? Because regulation 5.1 is the one which says that save as provided in these regulations, no person may do foreign investment from India, etc., etc. So this is a non-permitted way of investment and therefore it is a contravention of regulation 5.1. Second, receivables are retained outside India. Those were not remitted back into India. Receivables, any receivable should be brought back within those days. It was in FEMA, under FEMA 120 it was 60 days. Now it has increased to 90 days. Any receivables should be brought back within 60 days. If it is not brought back within 60 days, then it is considered as a loan. Indian resident individual cannot give a loan to the foreign entity. So that is contravention of para A8 of schedule 5 read with regulation 20A. So this is the second contravention. Third one, APR has not been filed. So he has contravened the obligations which are imposed or which are placed on a Indian investor. So 3 contraventions are there. So without these 3 contraventions being regularized, you cannot regularize the transaction. So we filed. So obviously this is a approval route transaction. UIN cannot be generated under automatic route. So we filed a application for Form FC under approval route for sending to RBI. So these are the documents that has to be attached. Copy of MT 103 for the initial remittance of Canadian dollar 1,695, evidence that money has gone out. Confirmation from Canara Bank. We took a confirmation from Canara Bank stating that this is the A2 under A2 for invoice, payment, consultancy charges, business services to the individual. No, that is payment under LRS. Correct, just professional charges that has gone out, right? So we took a confirmation from Canara Bank stating that this is the purpose code that was used. So they confirmed saying that purpose code used is XYZ. Then we got the invoice and we also got the share certificate issued in the name of the resident individual. In this, quite interestingly, one of the challenges that we had was that ICICI Bank wanted an additional confirmation from Canara Bank, or they wanted a no objection certificate from Canara Bank stating that we have no objections to you being the designated authorized dealer for this transaction. Canara Bank said, boss, why would I give that NOC? I have not handled a ODA transaction. Then why would I give an NOC? ICICI Bank said, sir, without this NOC, I will not take it to RBI. Canara Bank said that I will not give the NOC. So we were at a stalemate. Finally, we had to leverage our personal relationship with the ICICI Bank senior management team, get them to speak to senior compliance officers at ICICI Bank. Canara Bank said, boss, has this requirement for NOC come from RBI? If RBI has asked for this NOC, I will give. But if it is an internal requirement of ICICI Bank, I am not going to give this because this is not needed. And ICICI was not willing to take it. We said, boss, at least you go to RBI, you at least go and speak to them. They were unwilling to do that. Finally, we had to leverage our personal relationship. Then they said, okay, fine, we will go to RBI. RBI never asked for that. So, RBI, correct, it is logical. Canara Bank, yeah, it is only a current account. They have confirmed that I have done this under a current account purpose code. More than that, what do you need? Why would you want a no objection certificate? If they give a no objection certificate, this is like saying that no, I handled it as a capital account transaction, as an ODA transaction, but now I don't have any objection to you handling this going forward. Why would they want to do that? So, this is the only, you mean what should the individual have, what he should have done? Ideally, he should have remitted that $10 from India. That post incorporation of the foreign entity, immediately he should have done an outward remittance of $10 from India, and he should have got that $1,695 back into India. He should have done an outward remittance. UIN should have got generated against that outward remittance. Form ODI part 1 should have been filed. UIN should have got generated. Share certificate should have been.
Bank account ought to have been opened.
Correct.
And for opening the bank account, the company should be incorporated.
Correct.
And for incorporating the company, you have to pay the advance to the.
No, sir, advance is okay. You pay the advance. Nobody is saying that you shouldn't. Don't capitalize that. Don't capitalize that. Let the bank account be opened. Subsequent to the bank account being opened, you remit $10 from outside, from here in India, and then you get the amount back, 1,695 back, which is exactly what RBI asked us to do actually. In the name of the promoter.
Is there any private product between him and the basic? So, the current account declaration I am giving itself is not wrong. There is no services rendered to me personally.
No, sir. Yeah, no. I am engaging. I am the one who's engaging a consultant outside India. See, today, let's say for example, I want to incorporate a private limited company, right? I being the promoter, I being the largest shareholder, I am incorporating a private limited company. If I engage you for incorporating that company, you will raise the invoice on me, right? Pre-incorporation expenses, the invoice for that, I will bear it. Subsequently, that pre-incorporation expenses will be reimbursed. Either it will be reimbursed subject to approval. That's basically how it is. Now, here in this particular case, we went to RBI saying that this is a non-permitted way of investment. Please approve it. RBI said, boss, I am not going to approve it. I will not approve capitalization of pre-incorporation expenses. I will not approve that. I will permit you to make a deferred payment of consideration for shares. Where deferred payment of consideration also in 2022 only it came. Under FEMA 120, deferred payment of consideration was not there. But RBI said, yeah, it is not there under FEMA 120, but that is a lesser evil than permitting you to capitalize, the money held outside. So I will permit you to make deferred payment of consideration. So what you do now is, you make an outward remittance now. I will generate the UIN for you. You make an outward remittance, file form FC, make outward remittance for $10, and then you bring $1,695 back into your savings account, which you have paid, which is how it actually happened. So we made outward remittance of $10, inward remittance of $1,695 came in. Then LSF was paid for late reporting because financial commitment should have been done at that time. So late reporting of financial commitment for that LSF was paid. We filed APR for 2020, 21, 22, 23, 24 for 5 years. 4 of those years were late filings. So we paid LSF for the 4 years, and then RBI said, இதெல்லாம் முடிச்சுட்டு come to me for compounding. So now we are filing the compounding application for this. For these contraventions, for these 3 contraventions, for investment by way of capitalization, it is a compoundable offence. This is a compoundable offence, right? This is regularized by way of LSF.
That's what I. So the same offense, one is LSF, other 2 are compound.
Correct. This is LSF for these 2. Correct. 2 items. For these 2 items, we are approaching for compounding. This has been regularized. So that LSF again, when we paid, that was again another horrendous drama. One of the LSF provisional acknowledgement, when ICICI Bank generated it, they made a small mistake in the email ID. So instead of rajagopalanAR@gmail.com, they generated they submitted the application with rajagopalanr@gmail.com. That provisional acknowledgement from RBI went to some rajagopalanr@gmail.com was never received by the client. And client is waiting for provisional acknowledgement, bank is following up. Finally, we got a PDF of that from ICICI, we got a PDF of that email from RBI saying that 7,500 LSF has to be paid. Now this gentleman, he paid the LSF. Now he has to send an email to Chennai regional office. He sent an email to Chennai regional office, and very beautifully, so this is why I tell all my clients, you make the payment, you give the data to me, I will send the email. Now he sent the email. Instead of giving the LSF reference number in the email, what he did was that he took the APR filing transaction number from project profile and he put that. So December 19th, he paid the LSF and we are waiting for the final acknowledgement. Final acknowledgement will also go to rajagopalanr@gmail.com. It will not come to rajagopalanAR. Then we kept on sending emails to FED Chennai, and finally we called up FED Chennai, and then they came back and said, sir, this has already been acknowledged. On 8th of January it has been acknowledged. The acknowledgement email has gone to that mail which was there. It has also gone to your bank, but they were kind enough to acknowledge on email, on the follow-up email that we sent. They were kind enough to send reply to us saying that this has been taken on record. So even though the final acknowledgement is not there, we are now using that as evidence that LSF has been paid. So procedural compliance is quite complicated. So this is basically how the entire thing has been.
So one more practical doubt is that why is it that the resident individual is not allowed to give a loan? What is the reason?
Sir, quite difficult to figure out the regulatory thought process behind it. But my thought process is that I think it is related to why resident individuals are not permitted to invest in entities which have stepped down subsidiaries. Probably one of the things could be that there might be giving a loan is again something which has to be managed quite well. One is that you need to understand the business, you need to understand the credit quality, etc., etc. So whether the individual has got the ability to appreciate or do that kind of due diligence, etc. Correct. When he has an equity holding, it could be that. I'm just it's my conjecture. Again, why is a resident individual not permitted to invest in a foreign entity with step down subsidiaries? See, step down subsidiaries means complex holding structures. Now, as an individual, the individual might not have the management bandwidth and the capability to handle those kind of complex holding structures. Whereas if it is an entity might have the management bandwidth and the management capability to handle such complex structures. Could be related to that. Which one, sir?
Individual making a loan to foreign entity that is invested. Investment comes under OEA.
Correct.
Comply with that.
Correct.
What can I do it under LRS?
No, sir, you cannot. No. LRS says that investment subject to and all investments have to comply with OI rules. So, OI rules specifically prohibit from giving loan. Yes. So, if you look at FEMA 120 also, FEMA 120 also specifically prohibited.
Other regulation on borrowing and lending by residents, which overrides?
So, OI, anything related to overseas investments, it has to comply with the OI rules. Anything related to overseas investments, it has to comply with OI rules. Huh. Correct.
Financial commitment includes investment in capital, the borrower, money lending or but when it comes to individual, it is only investment.
So, yes. Anything that is done is financial commitment, whether it is a resident individual or Indian entity, it is financial commitment. If you look at FEMA 120, FEMA 120 specifically says that resident individuals, this part, para A8 of Schedule 5. What does para A8 of Schedule 5 say? Schedule 5 describes what is, what are the prescriptions for an individual to do an overseas investment transaction. Para A8 says that financial commitment, which is included in the definition of direct investment under regulation 2E. And regulation 2E of FEMA 120, if you go and read, it says investment in equity instruments. It does not talk about loan. So, unless you comply with, you have to read this with regulation 2E. Regulation 2E says only investment in equity. So, this is what is permitted, specifically permitted for resident individuals. I am not taken what is the, that same language would have got replicated in OI rules as well. So, LSF has been paid for financial commitment, the delay in filing of APR. Now, compounding application is being prepared and filed. So, this is the second one. Okay, resident individual, two resident individuals invested in a foreign entity, incorporated a company in Malaysia. 50 ringgits each they remitted, they incorporated a company in Malaysia. Now, after that, an Indian company, they also invested in that same foreign entity and they took the majority stake in the foreign entity. Subsequently, what happened was that one of the individuals who had invested in that company, he became a non-resident. He went outside India, he went to Malaysia, he became a director in that company, he received salary in that company and that money was credited to his foreign currency account outside, and from those monies he invested further in the foreign entity. Now, he already had Indian shareholding in that foreign entity which he had remitted from India, recorded in project profile, etc., right. So, if you look at the shareholding pattern, you will see given in case 2. So, the shareholding pattern in the company in the foreign entities books, they said that all these shares are allotted to that particular gentleman, right. Now, the Indian company, they filed APR, and when they filed the APR, they captured the shareholding pattern as what it was captured in the foreign entities books. Okay. So, which is not matching with the project profile, because in RBI's project profile, only 50 ringgit remittance is showing as share capital of this gentleman, of this individual, whereas in the books of the foreign entity, 550 ringgits is showing as the share capital. So, the shareholding pattern does not match. So, the bank rejected the APR, saying that it does not match. Now, how do we regularize this? Now, in terms of contravention, there is no contravention, in the sense that a resident individual can subsequently become a non-resident, and he can invest as a non-resident also in the same entity which he has invested. There is nothing prohibiting it. So from a contravention perspective, there is nothing. It's only a reporting delay. Because any post-investment change in the shareholding pattern under FEMA 120, it should have been reported within 30 days. In this thing, under OI rules, it has to be reported under. Yes.
So simply there is a change in shareholding.
Correct. Any.
There are not the Indian people are involved.
Correct. Any post-investment change in that shareholding pattern under FEMA 120 within 30 days from the date of that change happening, under current rules, when you are filing the APR, you need to update the shareholding pattern. But in this case, the challenge was, how do you reflect that change in shareholding pattern? Because in the project profile, you have to give the names of all resident shareholders and all non-resident shareholders. Here, the problem, so for the overseas investor, there was, the individual investor, there was no reporting obligation because he had done the remittance from or investment from outside India. For the Indian entity, these were the obligations. Now, our challenge was that when we went and filed the change in shareholding pattern to record the same individual as a non-resident shareholder. So basically, Mr. X, who was a resident shareholder, is now also a non-resident shareholder. So same individual is a resident and non-resident shareholder. So if you have created a investor profile, the first time a resident investor or an Indian entity is doing an investment in a foreign entity, in the OID system of RBI, an investor profile is created. And this investor profile is linked to the PAN number. Subsequent all overseas investments that he does today in one company, company A outside. Company B, subsequently he starts another entity, he invests that. So that also gets linked under that particular investor profile, everything gets linked under that. So here the problem was that from the AD's side, AD agreed that this was permitted, same individual can be a resident investor as well as a non-resident investor in the foreign entity. But from the AD's end, they were unable to create or unable to record the same individual as resident as well as non-resident. Then we had to take it to RBI. This actually had to be changed from the back end at RBI. So that for that we had to run behind them for about a month, and we had to get that recorded. So first is you rectify the shareholding pattern, then you file the APR. So APR for 2022, 23, 24 was held only because of this. And a lot of questions. Bank wanted to validate that he was actually a non-resident. We had to give employment agreement. We had to. He was incidentally, he was also a director in the Indian company also at that time, and he was getting director's fee here in India. So then how can he draw salary here also? How can he draw salary there also? So then we had to say that no, this is only sitting fee, is not a salary. Salary he was drawing over there. This is sitting fee that he was getting as for being a director in the Indian company. So bank validated a lot of that. So a lot of back and forth happened. So finally, we were able to get them to take it to RBI, change it at the RBI back end, and then rectify the project profile first, match it off with what is being recorded in the APR. 2022, 23, 24, 3 APRs got filed.
How do we access the so-called project profile?
You can ask your banker. Yeah. You can. We have to go through the banker. Banker, it is a 5-minute job, sir. You will get it. You can get it through the banker. So this was basically how it happened. So the 500 ringgit invested by the gentleman, we classified it as non-resident investment, and LSF paid, APR filed, all that done.
So if you had given this information within 30 days of this happening, maybe you could have avoided all this.
No, you would still need to, because the AD would not be able to change his, capture him as a resident plus non-resident. Even then, from a reporting perspective, reporting timeline perspective, the Indian entity would have complied with their requirement, but that change would have taken a little more time to get it recorded in the system. So third one, this is okay. So this is where I said there is a difference in treatment of subscription to MOA under FEMA 120 and the new OI rules. Under FEMA 120, when an Indian investor incorporated a company outside and subscribed to the MOA, there was no reporting obligation that was placed on him at the time of the company being incorporated. When did the reporting obligation come? Reporting obligation come only after the bank account got opened over there and the remittance went from here. That is when the reporting obligation got placed on the Indian investor, right? Now, under FEMA 120, under the new OI rules, RBI now considers signing the MOA or getting the certificate of incorporation as financial commitment. So the reporting obligation starts from that point itself.
Same like the Companies Act.
Same like the Companies Act.
Because it's a contract you sign and agree to take the shares.
Absolutely. Sir, unfortunately, when we, in case of FDI, that is still a challenge for us. Because Companies Act considers the foreign investor as a shareholder immediately on issuance of the certificate of incorporation. But under FEMA, we still have to consider him as a shareholder only after the inward remittance comes in. We still have a challenge with that.
There are cases where inward remittance come 1 year later.
Yes. So here in this particular case, it was done in September 2022, and therefore this was under OI rules. So Indian investors are permitted to invest in foreign entities and accept shares against the same by deferring the payment of capital for such time as mutually agreed. So financial commitment is done on the date of issuance of certificate of incorporation. You become the shareholder on the date of certificate of incorporation, but you still cannot pay for it because bank account is not yet opened. So this automatically it becomes a deferred payment transaction. You are a shareholder, you are paying the consideration subsequently. This deferred payment is something which came in 2022. This permission, right? So liberalization of provisions, but the problem is that subscription to MOA is not is to be treated as investment by deferred payment. So this is the
Where capital can be even zero. See, you have a capital of $100. Then I undertake to subscribe to 50%. Then that is a commitment. That is a financial commitment. When the capital itself is zero. Okay. So because the company will commence the business based on their collection and all, they will remit.
okay.
So when there is no capital itself, then there is a question of commercial financial.
So basically, this is where RBI says that if you are a subscriber to the MOA, you are making a financial commitment.
In the memorandum, we say 10 rupees, 100 rupees. We say. In this case, capital itself will be zero.
Understood, sir.
Subscription also will be zero.
Understood. So here you have to, so what FEMA says is that if you have signed on the MOA, if you have agreed to be a shareholder even with zero investment, then that is a financial commitment. Which there is no money that is going out. There is no money. So
On a future date, when there is a need,
you will bring in money. You will bring in money. I have another case which I handled, under FEMA 120. There was a gentleman who incorporated a company in China, and apparently in China there is a 30-year time period, within which you can infuse capital. Now this was a trading company. That particular entity did not require any capital from India, and therefore he did not remit at all. It was a trading company. He got advances from suppliers, from buyers, and he used that money to pay off the suppliers, and the business ran as it is. Now the problem is that since there was no outward remittance done, UIN was not generated. He went to one of the banks twice to record the transaction, and they very clearly told him, unless and until outward remittance is there, I cannot generate a UIN. Right? So he came back and he did not generate the UIN. Subsequently, he closed that company. About $250,000 he brought back into the country without investing any money. And when the money came in, it went to another bank. They asked him, sir, where is your UIN? He said, I don't have a UIN. I went to the bank twice to get the UIN. They did not give. Sir, where is your APR? Sir, UIN is not there. Then where is the question of filing APR? Then they told him, sir, you do one thing. You cannot declare this as disinvestment proceeds because you don't have a UIN for this. So you declare it as, orally they told him, you declare it as trading income and you get the money in. So $250,000 he took into record into his books saying that this is trading income. Now there is no record of the bank having advised him to do that. The bank will, if there is any problem that comes in future. No, trading income, trading. This is not trading income. There is no export. There is no export. Trading income. Okay? There was some trade that happened outside or some bought outside and sold outside kind of thing. Anyway, he took it as an A2 remittance into the country. So he declared it as an A2 inward and he got the credit into his account. Then he got scared. He said, what if tomorrow Enforcement Directorate comes calling? What will I do? Huh? Yeah. Sir, tax income, at least you can pay the tax and you can. Correct. So that is one part. On top of that is that some 15 years later, some investigating officer will pick up something and send him a show cause notice and say, sir, please come with your Janam Kundali, sit in front of me, and then you, narrate the story. So he said, sir, I want to, get a clarification. So we went to both the banks. Both of them were unwilling to take it to RBI. We sent it directly to RBI's OID division, put everything together, put it in courier, send it to OID. OID sent it back saying that unless and until it comes through the AD, I will not be able to look at it. Again went back to the AD. AD said, since the transaction is now closed, we are not willing to close. I said, sir, you do one thing, keep all these communication in a file, retain it. Tomorrow, if there is any inquiry which comes, you can say that, sir, I tried my level best to report. Bank was unwilling to take the transaction on record. What do you want me to do? That is the only thing that you can do today. Nothing else. So, but now, under the OI rules, the moment a company gets incorporated outside India, it is considered as financial commitment. That is basically how it is. So here also, in this particular case, so under FEMA 120, subscription to MOA and incorporation, certificate of incorporation did not trigger any reporting requirement. FE needs to wait for bank account to be opened. Reporting obligation gets triggered only when outward remittance happens. That was under 120. Under the new rules, subscription to MOA is considered as incurring financial commitment at the time of executing the MOA or issuance of certificate of incorporation. That is the date of financial commitment now, right? And remittance is not done upfront, so it is considered as acquisition by way of deferred payment of consideration. So this has to be reported in Form FC as non-funded obligation. And the, in section C of Form FC, there is item number 18, others. There it says deferred payment. So that is where you have to mention this. So here you have to mention, and what I tell my clients is that, see, you need, again, what it says is that the period of deferment has to be explicitly captured. Two ways of doing this. In most cases, what happens is that client would not know about it. He will incorporate the company, then he will come to us to make the outward remittance. That is when we will tell him that, sir, you should have actually reported this upfront. So the MOA will not have anything about deferment of consideration. So in those cases, in 3 cases that we handled, what we did was that we created a agreement between the investor and the foreign entity, deferred payment agreement we executed, wherein we said that we agree to defer the payment of share capital by 6 months. In one case, we did it for 3 years. Because in this case, we did it for 3 years because entity was incorporated in September 2022. So we had to execute a deferred payment agreement saying that we agreed to defer the payment of share capital by 3 years, by 36 months. That is how we had to do it. In other cases, it can be for 6 months, 1 year, etc., etc. If the client is coming to us upfront, then we have to tell them that, sir, this is a necessary clause that you have to include in the MOA itself. Please include in the MOA saying that investor can infuse share capital within 6 months, within 1 year, etc., etc. You have at least an indicative timeline as to how much time it will take for you to get your bank account open and get the share capital infused. So here what we did was that deferred payment agreement we put in place, and along with the deferred payment agreement, so 2 Form FCs have to be filed. The first Form FC is the one where we say that investment by way of deferred payment, this is recorded and UIN is generated against this. Then using that UIN, we file the second Form FC, wherein we say that the deferred payment obligation is now being converted into an actual infusion of capital for the remittance to happen. And since that Form FC for the original deferred payment should have been filed in 2022, that is a delayed reporting. So modalla you have to generate UIN, generate the provisional acknowledgement for LSF, make payment of LSF, get the final acknowledgement, then you have to make the outward remittance for infusion of capital. So in fact, incorporation of new entities has become fairly complex. The procedural aspect of incorporation of new entities outside India has become fairly complex because of this. Earlier it was not so complex. Once the bank account gets opened, you make the outward remittance, you file Form ODI Part 1, UIN gets generated, outward remittance goes, that was it. Now for the same activity, 2 reporting needs to be done. In most cases there is a delay, and when that delay happens, then you have a LSF liability. And in the case of LSF, more than the amount involved, it is the procedure, because even after you make the payment, the final acknowledgement, you have to still wait for the final acknowledgement to come, and until and unless the final acknowledgement comes, the bank is unwilling to handle any further transactions. So they will wait for the final acknowledgement to come.
New deferred payment reporting only for new entities formed after 2020.
Correct.
Or it also applies to old entities.
No.
Let us say the subscribed the memorandum, there's a capital of 1 lakh. The company has subscribed 50,000. Accordingly, FC has been filed. Whatever was the previous form was filed. The balance 50,000 still has not been subscribed.
Correct.
Now we come to post 2020. Should we now file FC deferred payment for the balance 50,000?
Very interesting question, sir. I think this was there an agreement saying that within this particular timeline, the balance subscription, there is nothing. No such agreement. Then on what basis? Because typically,
Post-country laws obviously will have a
No.
That certificate should be issued within the Companies Act has such.
Correct. Again, I mean, just to complete that answer, typically what I have seen is that if your MOA says that the share capital is $100,000, then bank will refuse to do an outward remittance of less than $100,000. Bank will say that this is my experience with ICICI Bank. I mean, because we have had clients come to us and say that, sir, MOA is for 100,000. I want to pay 50,000 now, 50,000 later. We have gone to the bank. Bank has said, no. Whatever is there in the MOA has to be paid upfront. Because again, this question of what will you do with the balance amount of money?
Paid based on a call letter received from the company. The call letter was only for $50,000. There was no mention about one.
So this was what partially paid shares?
No, these are fully paid shares.
Fully paid shares.
For reasons best known to the company, they had a shareholders agreement saying that there were 5 shareholders. They agreed to bring in around 100,000, whatever, $100 million.
Okay.
Divided in certain ratio. But when it actually, the call letters were issued, they were issued for a far lesser amount because this $100 million was to be brought in over a period of time.
Okay. Okay, understood. Have to look at this, sir. I think this will have a little bit of interpretation to be done on this. Because deferred payment was not permitted under FEMA 120. So that becomes a contravention if you have to consider it as deferred payment. Whether unpaid subscription money will have to be considered as deferred payment, and if it is considered as deferred payment under FEMA 120, then it is a contravention. If it is under OI rules, it is permitted, but then the financial commitment should have been reported upfront. So those kind of interpretations will have to be taken. So we have to look at the transaction and then we will have to figure it out.
MOA does not have such a clause for deferred. The best way is to have a partner agreement.
Correct.
So that, where you have the other shareholder also.
Ah.
Other shareholder, the examining and the Indian.
Yes.
Stages through which money should be processed.
Yes. That is what we correct. That is how we did it. Because for another case, for husband and wife individuals incorporating a company in Bahrain, along with a shareholder from Bahrain. So there we had a deferred payment agreement with the company and the 3 shareholders. So 4 parties in that agreement, wherein it was very clearly mentioned that the shareholders will infuse money within a period of 6 months from the date of incorporation, on the basis of which UIN was generated and subsequently share capital was remitted from India. So that is basically how we did. But ideally, if we are engaging with the client prior to incorporation, we should try and get this incorporated in the MOA clauses itself. That is the best way to do it. So subject to host country regulations. Yes.
Because if it is a Companies Act in India,
That is not possible. It is not possible.
no Companies Act will allow this.
Then you have to have a.
Within the prescribed time. In India also, the Act doesn't say within which time you should pay the subscription. But you have a provision within what date you should issue the share certificate. That's the receipt of the Companies Act is very clear. That's what I'm saying, obviously. No, it's an interpretation. The law says you should issue the certificate within this date. That means you should have paid the.
So last one, currently ongoing, fairly complicated issue. So Indian company, 2011, they made a investment in a foreign country, set up a subsidiary which is an investment SPV. That investment SPV subsequently acquired an operating entity in that same country. So from here, India, $10.5 million was remitted out to the investment SPV. Investment SPV generated funds from outside India by way of debt, etc., etc. About $26.5 million was used to acquire the operating company. Now, what happened was that, so against that 10.5 million, the Indian company received about 26,500 shares. And the step down subsidiary, the operating entity, it issued about 1.6 million shares against 26 point whatever million investment that was done. Subsequently, a lot of issues happened. COVID happened, the financial crisis of 2008-9 happened, automobile, it was into automotive components. So a lot of buyers went away. So operating entity started making losses. This was the only entity under the investment SPV. So the investment SPV also started accumulating losses. Finally, in 2022, what they decided was that both these entities, they will file for insolvency protection. The operating entity, the step down subsidiary as well as the direct subsidiary, both of them, they will apply for insolvency protection. Now, when they filed for insolvency protection, it was ultimately, administrators came in, and administrators finally decided that operating entity can be permitted to continue as a going concern, provided someone else can come in and take over the business. Someone else can come in and become the shareholder, because the investment SPV obviously does not have the ability to manage this. So if someone else can come in and become the investor, then the operating entity, the step down subsidiary, can be permitted to continue. So what happened, the Indian investor who had originally invested, he said that, okay, I am willing to step in and make that operating company as my direct subsidiary and run this show. So then what happened was that the direct subsidiary, which was holding 1.6 million shares of the step down subsidiary, they executed an assignment agreement in favor of the Indian parent company, stating that I am assigning and I am transferring these 1.6 million shares that I am holding. This happened in August 2023. So August 2023, they executed a assignment and transfer agreement whereby 1.6 million shares held by the direct subsidiary outside India were transferred to the Indian parent company. So the step down subsidiary now became the direct subsidiary. So after they became the direct subsidiary, then the court passed an order permitting it to come out of the insolvency process. They passed the final order on that. Then now the direct subsidiary, original direct subsidiary, that insolvency application was filed and that went on, and in September 2024 an order was passed stating that now you can shut down this company. Okay. How do you report this? So we went to RBI. This application has been filed with RBI. Engagement has been happening since 2023, so almost 2 years now. Was with the AD for quite a long time. About 6 months back went to RBI, so for the past 6 months it is with RBI. So a few questions that we looked at and we tried to answer from our side, and how RBI has looked at it. We said that you have to look at it as a merger or swap of shares, more like a swap of shares, because against the 26,500 shares that I was holding in company X, instead of that I am getting 1.6 million shares of company Y, because the 10.5 million investment that I did, that is gone. I am not getting any money out of that, right? 1.6 million shares I got without making even a single paisa payment. So basically it is like against that 10.5 million I am getting this, right? Against the original 10.5 million that I have remitted out, today I am holding an asset of 1.6 million shares. And we did a valuation. That valuation came to, the operating entity then was valued at about $15.7 million. So the value of that asset is definitely more than what I have remitted out. So obviously valuation norms are being met. It is acquired at a price lesser than the fair value. So that is also not a concern. RBI is like, boss, how can you say that it is swap? Because when you received the shares, your investment in the other entity was still live. That entity was still live. Ideally, if it is swap of shares, that entity should go off and parallelly you should get this. So how can you say that I got these shares in August 2023 and that entity got liquidated in September 2024, 1 year later? So that is one challenge that RBI has. Second thing is that we did a valuation of, so they wanted to understand if you are, okay, now you are saying swap. What is the swap ratio? He said, sir, there is no swap ratio. How do you arrive at a swap ratio? Because I was holding 100% equity in company X, for which I paid X amount of money. Now I am holding 100% shares in company Y, for which I did not pay even a single paisa. So if you want a swap ratio, 26,000 is to 1.6 million, that is the swap ratio. But how do I say that this is at a fair value? Because I have not done valuation of the direct subsidiary. Why? Because it was under insolvency protection. It had filed for bankruptcy. Under the host country laws, it has filed for bankruptcy and it has now got closed. That entity had accumulated losses, because of which it was not, it could not be considered as a going concern, and therefore we had to shut it down. Now, how do you say that you have to do a valuation of that entity? But that is the current requirement. RBI has said that you get me a valuation report of the direct subsidiary as on the date on which you did the transfer of shares, as on August 2023. What was the valuation of that particular entity? So now we are trying to get that done. They wanted this explanation of 1.6 million shares assigned and transferred in August 2023. So why are you saying that? We explained to the AD saying that it has to be considered as swap, because that is the most logical way you can look at it, and they explained it in the same manner to RBI. RBI in turn asked them, how do you say that it is swap? Then they came back and asked, sir, how do you say that it is swap? So we said, sir, 10.5 million money that I have sent out, instead of 26,500 shares, today I am holding 1.6 million shares. So instead of this money coming in, no, you have to show that as write-off. I said, sir, if I do that as write-off, then what am I going to consider this amount as, this investment as? See, there are two reportings here. There is a disinvestment reporting, because there is an existing UIN for the direct subsidiary. Correct. Now? Originally, no. No, originally, no.
There is some provision of disinvestment that reduction in equity value should be not more than 10% in the
No, that is
proportionate loss.
that is restructuring. No, this is not restructuring. This is not restructuring because that entity. No, sir. See, in restructuring, we are considering that the entity whose value is being diminished, it continues as a going concern. In this case, that entity has got knocked off. So, there are two reportings. One is a disinvestment reporting, wherein the direct subsidiary which was earlier in existence has got knocked off and gone off. So, that UIN has to be closed. Right. So, disinvestment has to be reported, that UIN has to be taken out. Number two, after the bankruptcy order. Number two, a new UIN has to be generated for the step down subsidiary which has now become a direct subsidiary. So we filed two applications. We filed Form FC section A to E for generating a new UIN for the step down subsidiary, and we filed a disinvestment application Form FC section G for reporting the disinvestment of the direct subsidiary. The problem is the time gap between the two. Now, RBI's question is also very valid. In a regular swap transaction, one asset will go off and the other asset would come in at the same time. But here the challenge for us was that, the problem for us was that, if that assignment and transfer did not happen in August 2023, we would not have got an approval for the step down subsidiary to continue as an operating entity. That had to happen. Otherwise, it should have got to, I mean, someone else should have come in and should have taken it over. Instead of that, we wanted that asset to remain within ourselves, and that is the reason why, we did it. So this is basically the challenge that we have. So, I mean, we still don't have a solution. It's still an, evolving case that we have. Is still.
This transaction cash the idea without tax. They will perceive as if the Indian company is getting the shares of one operating company free of cost.
Yes.
So it has
Yes.
implications.
Absolutely.
Valuation of the operating.
Yes.
If it is negative, no problem.
Valuation of the operating company. It is not. It is 15.73 million. 15.73 million, 1.6 million shares. Okay. So I mean, yeah, you are right. There is a tax implication there also. So they are working with tax consultants also on that.
You are getting these shares for free from whom? From a foreign company.
Correct.
Will not SIRC involved?
No, sir. No. So no. It's not gift. It's not gift. No. So this is.
How it is gift? You are not doing anything.
No.
Continue to be the shareholder of holding company. They are giving the shares of the assigning the shares of the.
No. So this is basically, which is why we are saying that the value, because when we prepare Form FC, we have to say what is the financial commitment amount. No, so the financial commitment amount that we have mentioned over there is 10.5 million, which is the original investment. The value of financial commitment is 10.5 million. In the direct subsidiary. Now the challenge is that again, that particular Form FC was provided or was submitted prior to the liquidation of the direct subsidiary. So between August 2023 and September 2024, the Indian entity actually had two subsidiaries under it. It had the step down subsidiary, which has become the direct subsidiary, and it had the original direct subsidiary. So now what do you take it as the aggregate financial commitment? We chose to keep the aggregate financial commitment as 10.5 million only. Stat auditors also agreed with us. They signed it off saying that aggregate financial commitment is 10.5 million because you are getting this in lieu of that 10.5 million. So we kept it as 10.5 million only. Now I asked the CFO, sir, what are you going to show it in your books? He said, sir, I will have to show impairment on my original investment of 10.5 million and value that investment as 0, and I have to value the current investment at 10.5 million. So my aggregate investment I will show in my balance sheet as 10.5 million only, which I think their stat auditors also agreed.
They will capitalize the, say, another extra 16 million.
Correct, 1.6 million.
But instead of all this, did you examine a possibility of a cross-border merger between the wholly owned subsidiary and the direct subsidiary, so that you have only one subsidiary?
We tried that, sir. We tried that. So which is why both the applications were filed simultaneously. But the courts, they chose to look at both the applications separately, and they said that we are willing to let the operating entity continue provided we have a commitment of investment from someone else coming in. So in fact, which we have kept out of this and which we have kept outside the discussions is that there was an escrow account. The courts actually wanted that escrow account to be, it is not mentioned. No, I don't think so. Okay, anyway, so there was an escrow account and the courts actually wanted a specific amount of money to be credited to the escrow account and the transfer of these 1.6 million shares to happen. Now that escrow account could not be funded from India. So they actually used another entity of theirs outside India to give a loan. It was not an equity investment. A group company outside India gave a loan to that operating entity and credited the funds to that escrow account. And now that loan has been repaid outside India itself. So since that transaction has happened outside India, that is not getting reported and is not getting discussed over here. But if you look at the court records, that requirement is also there in the order and in the insolvency application, etc. of the host country. We had to give that. We had to give. Actually, this happened even though I'm saying US and dollars, this happened in Germany. So we had to give translations of all the documents, get all the notarized translations, and we had to give all that. So still ongoing. I think hopefully in the next 6 months' time we will be able to get a resolution to this. Bank is DBS. Running with them. Even today we had a call. So we said, at least put us in front of RBI. We can explain what happened. But they spoke to RBI. The RBI said, no, if you have queries, we will come back. Now I have asked you for APR of 2023 and I have asked you for the valuation report of the direct subsidiary. You give us those two documents. If you have further queries, then we will get the client to come and meet us. So this is basically what it is. So again, the thing is that clients will go and do which it would have been much more simpler to take this to RBI first, get their concurrence and then do it. But then the client has already done all this transaction. Now it is left to us to clean up all the mess and to get those things sorted out. So that is our last case. So yes, sir. So anything, any queries? I know we have. The beauty of such a small group is that we have such freedom of focused discussion, and all the queries coming in, and engaging instead of becoming a monologue. It became it actually became interactive, very interactive session. So thanks a lot for that, sir. Yes, sir.
Capital reduction. There's a foreign entity which has done a capital reduction rather than a buyback.
Okay.
Whether it will amount to restructuring under the rules or it will amount to transfer or liquidation.
Sir, my view is that it will amount to partial disinvestment. It would not amount to restructuring, because restructuring would be in cases where there is a diminution in value, right? So we have to validate that by way of a valuation report which says that the investment has reduced in value because of accumulated losses by XYZ percentage.
No, sir, here in this case, there is no loss.
Exactly, that's what I'm saying.
Capital parked in the
Absolutely.
entity which we want to get back.
Yes, absolutely. So, in the case of restructuring, you will not have an inflow of money. So, when you have an inflow of money from the foreign entity, it is partial disinvestment. So, you have to. It is akin to a buyback. It is similar to a buyback. You will have to file Form FC Section G over here.
So in this case, sir, assuming that the foreign entity is a 100% subsidiary, is it mandatory to go for a valuation?
Sir, disinvestment, is there a, just like an NCLT process over here, is there a similar process that happens over there? No. If it is not there, then you have to go for a valuation.
But what is the necessity for a valuation? There is only one shareholder.
I understand that. See, there are some things where there is logic, some things where there is no logic, right? Now, the rule says that financial commitment transaction, either increase in financial commitment or disinvestment, has to happen as per valuation norms. Okay. Now, RBI has till FEMA 120, RBI used to say that you need to provide XYZ documents. To validate the valuation, you need to provide a valuation report. Today what has happened is that under OI rules, what has happened is that RBI has delegated it to the bankers. And each banker has to set up and has to prepare and has to put in place a board approved policy wherein they will prescribe what are the documents that they will take for XYZ transactions, for each transaction. Now here again, whether this transaction requires a valuation report or not is something which will be decided internally by the bank. Number one. So why I am saying this, why they are asking is that the requirement under the law, it says that it has to be subject to valuation norms. It is happening at arm's length pricing. So as far as the banker is concerned, he has no other way of validating whether the transaction is complying with valuation norms or not, except for asking for a valuation report. This is exactly like them asking for a CA certificate for anything and everything which they can't validate on their own.
Now, can a valuation report be given? Assuming that they insist on this, can it be given on a current date? Not prior to the actual capital reduction, but post current date can be given?
Sir, your date, see there are two dates, no? There is a date of valuation report and then valuation as on date. Date of valuation report can be today. So in this case also we have to give a valuation report which validates the valuation of the company as on August 2023. But my valuation date will be reported today, will be dated today only. Report will be dated today only.
So valuation date will be that date.
But date of valuation report will be today's. So I think, when we do FCGPR filing also, these kind of things come quite often. Client has not taken a valuation report at that time, we have to take a valuation report today, but date of valuation will be, that date on which the, correct. So that gets accepted. So I think this is possible.
I've been able to persuade the banker to take the FC section G without valuation. I'm only wondering whether he will come back and ask for a valuation.
If it gets reported, see, the thing is that again, today, what is happening is that, particularly as far as OI transactions are concerned, AD is only one of the checkpoints. The ultimate decision, even though we say that it is waiting for ratification by RBI, ratification is almost like an approval. So RBI can, at any point of time come back and they can ask. I'll give you another example, sir. Another case that we are handling. Company invested, set up a foreign entity in US in 2004, and they disinvested in 2009-10. Punjab National Bank is the authorized dealer. They submitted a letter to PNB in 2009-10, but they never followed up on that. The thing never got disinvested. UIN is still live. Okay, we are now getting it closed. We gave all possible documents. It has gone to RBI. The latest query that has come from RBI is that, so the client, when they did the investment in 2004, they did originally the subscription to MOA. Subsequent to that, they did 4 remittances, outward remittances from India. 2004-2005 nobody asked for a valuation report.
Thank you.
Right, sir. Thank you. Nobody asked for a valuation report. So now RBI has come back and said that, sir, those 4 remittances, I want a valuation report for those 4. December 2004 and January 2005, spread across these 2 months, there are 4 remittances. Now we are preparing a valuation report dated 15th of December, which will cover all those 4 remittances. So this is something which has gone, and for the same client, in 2018, I did a disinvestment. They had done a investment in Iran, and that investment, because of the devaluation of the Iranian currency, it had gone completely sour. The amount was only about 1.5 lakhs. So the client wanted to disinvest, and he wanted to disinvest without getting even a single paisa. Anyway, company net worth had eroded to negative. Company was not being closed down. He was transferring those shares to the joint venture partner in Iran. And that guy said that, sir, I will not give you even a single paisa. I am willing to do you a favor and take up these shares. I told them, sir, get at least $10 because you will have an inward remittance coming in. But that guy was unwilling to do even that. So finally, we did the disinvestment without even a single paisa coming in, wrote off the entire investment that was done on the basis of a valuation report which said that the fair value is negative. We filed that, it got approved, and the UIN got cancelled. So those kind of things have also happened. It was under the, that provision where up to $10 million of, under FEMA 120, there was a provision that up to $10 million you can write off, unlisted entities can write off where the aggregate investment is less than $10 million. So we did it under that. And it got accepted. Whereas in this particular case, the money that is repatriated is more than the investment. Money was repatriated. It was investment at profit. They closed the company. It was the disinvestment happened at a price which was more than the fair value. Despite that, just to record the disinvestment, now we have to go and create valuation report for 4 remittances done in 2004 and 5.
Just to tick off the line item.
Absolutely. Yes. There is no other significance. There is no. Similarly, another case, Chennai-based client invested in a company in Bangladesh in 2009, disinvested in 2010 because loss happened. They didn't want to come. Disinvestment happened at a loss, of course, because it was a transaction that happened. All documents have been given, everything has been given. The only thing that is pending right now, what we have also given right now is that the Bangladesh entity, when they remained invested in that foreign, when the Indian company was a shareholder in the Bangladesh company, that Bangladesh company had a loan from PNB Hong Kong. AD from here was PNB, still is PNB. PNB Hong Kong had given a loan to the Bangladesh company. Before they exited, they had closed that loan. RBI wanted the NOC pertaining to that loan. What is the relevance of closure document of a loan availed by the foreign company for reporting the disinvestment? But that is what it is. If he asks, you have to give it. Fortunately, the guys had a soft copy of that NOC, so he gave it to me, and we have given it.
It's a practical question. Some companies have not been filing the APR for ages. Now we have this 3-year window which is coming to an end by 22nd of August 2009.
Yeah.
So அதுக்குள்ள APR-லாம் ஃபைல் பண்ணி audit report-லாம் கொடுக்கலாம். இப்போ audit report, there's nothing to audit basically.
Correct.
So what is the sanctity that RBI attaches to the audit report? Suppose we give a disclaimer about it, or we give a qualified report. Will it be accepted for the purpose of APR filing and all?
My reading is that it should be, because particularly when you are talking about old transactions, 2009, 10, 11, 12, etc., if you are talking about that, there is no way for an auditor here in India to sit and validate those numbers of that times. I think it is, again, as Sridhar sir mentioned, it is a box ticking activity. Regulation says that, or the law says that it should be on the basis of audited financials. An audit report.
Client comes to me and I don't have the relevant information. I can put it in the audit report.
Sir, you have no other way, no other option. It should get accepted. It should get accepted.
Certain bank accepts, especially when you give an Indian auditor gives the auditor for foreign entity, it's a caveat. Those
Correct.
are not being accepted by certain banks. Some banks accept, some banks. If I may name it, maybe Kotak does not accept.
Acha, Kotak does not agree.
Other banks accept.
One more thing is, ICAI said, whether an Indian auditor can audit the accounts of a foreign entity. That is very clear.
From FEMA perspective, there is no problem. So, RBI says that, boss, I am not your regulator. Your regulator is somebody else. If your if ICAI permits you to audit the financials of a foreign company, you please go ahead. But from a acceptability perspective, ADs and RBI accepts financials audited by Indian auditors, or foreign entities audited by Indian auditors. There is no express prohibition. Correct. There is no express prohibition.
Because in one case, at the time of filing APR, they accepted. At the time of filing that FC section G, they asked for an audit by the auditor in that relevant country, host country.
Okay. No, but I mean, at the time of filing FC, why would?
They are going through all the APRs, whether it has been filed.
Acha, okay. But as far as I have seen, so far, APRs have been accepted with audit reports by Indian auditors. It has been accepted. Particularly, where the operations of the foreign entity are very small, it doesn't make to, audit reports by auditors in those countries are phenomenally expensive. So,
That is the reason why people ask Indian companies
absolutely.
what would cost them 50,000 rupees here.
Correct.
It costs around at least 5 to 6 lakhs.
Absolutely.
And many companies are not, they don't have to get themselves audited.
No, correct. Which is what RBI also says. It is not mandatory. That doesn't mean that it is prohibited. So you.
That is the way it is expensive. So what is mandatory
Is not expensive. What is optional?
optional.
Correct.
That means they want you to pay more for a seat.
Correct. So that's it from my side, sir. And thank you. Thanks a lot. Thanks a lot for being such a wonderful and patient audience.